Investing in the S&P 500 throughout the year is not a shortcut to wealth. It's a proven path, a path built on discipline, patience, and one powerful force that most people underestimate: compounding. Every day, the market moves in response to headlines, data, and events no one can fully predict. Prices rise, prices fall, fear and excitement cycle endlessly. But beneath all of that noise lies a simple truth. Long-term ownership in productive businesses has historically created wealth for those willing to stay the course. Some of the most successful investors in history have said this plainly. Warren Buffett once stated, "In my view, for most people, the best thing to do is own the S&P 500 index fund." That advice isn't based on optimism, it's based on decades of evidence. Buffett understands that while individual companies fail, the overall economy grows, adapts, and expands over time. The S&P 500 allows everyday investors to own a piece of that growth. At the beginning of every year, investors are flooded with predictions. Analysts forecast market highs and lows, recessions, crashes, and rallies. It's tempting to believe that success comes from acting on these forecasts. But Buffett warned against this mindset when he said, "Forecasts may tell you a great deal about the forecaster. They tell you nothing about the future." Education starts with accepting uncertainty, then choosing a strategy that doesn't rely on perfect timing. That strategy is consistency. Investing throughout the year means you participate in the market regardless of conditions. When prices are high, you're still investing. When prices fall, you're investing at lower valuations. This approach turns volatility into an advantage through dollar cost averaging, reducing the risk of investing everything at the wrong time. To understand why this works, consider a simple example. Imagine investing just $10,000 into the S&P 500 and doing nothing else: no trading, no additions. Historically, the S&P 500 has averaged about 10% per year before inflation over long periods. At that rate, after 20 years, that $10,000 grows to roughly $67,000. After 30 years, it grows to about $174,000. And after 40 years, it becomes roughly $450,000. Nothing changed except time. This is compounding at work. Now, let's look at a more realistic scenario. Suppose you invest $500 per month, or $6,000 per year, into an S&P 500 index fund. Over 20 years, you would invest $120,000, yet the portfolio could grow to around $340,000. Over 30 years, you invest $180,000, but the value could exceed $1 million. Over 40 years, with total contributions of $240,000, the portfolio could grow to $3 million or more. At that point, the majority of the money didn't come from your contributions, it came from growth compounding on itself. This is why time matters more than intensity. Charlie Munger, Warren Buffett's longtime partner, put it simply: the big money is not in the buying and selling, but in the waiting. Education teaches you the math, motivation helps you wait. The S&P 500 itself strengthens this strategy. It represents 500 of the largest U.S. companies across industries like technology, healthcare, finance, energy, and consumer goods. These companies generate trillions of dollars in revenue, employ millions of people, and continuously adapt to the future. As weaker companies fall behind, they are replaced by stronger ones. Investors don't need to predict which businesses will dominate next. The index evolves automatically. John Bogle, the founder of Vanguard and pioneer of index investing, captured this idea perfectly when he said, "Don't look for the needle in the haystack. Just buy the haystack." By owning the S&P 500, investors own the market itself, the long-term growth that comes with it. Another powerful lesson of compounding is starting early. Imagine two investors. One invests $500 per month from age 25 to 35, just 10 years, and then stops. The other waits and invests the same amount from age 35 to 65, 30 years. Despite investing only $60,000, The early investor could end up with more money than the late starter who invested $180. Simply because their money had more time to compound. As Bogle famously said, "Time is your friend, impulse is your enemy." There will be years when the market feels boring, prices move sideways, progress seems slow, and enthusiasm fades. But these are the years when discipline matters most. Dividends continue to be reinvested, ownership grows quietly, compounding accelerates beneath the surface, even when it doesn't feel exciting. Then come the difficult years, the downturns, recessions, market crashes, and global crises test every investor's resolve. Fear dominates headlines, and selling feels like relief. But education reminds us that many of the market's best days occur near its worst. Missing just a handful of the strongest recovery days can drastically reduce long-term returns. This is why Buffett advised, "Be fearful when others are greedy, and greedy when others are fearful." Staying invested throughout the year keeps you positioned for recovery over decades. This approach has repeatedly rewarded patience. Wealth is built not by predicting markets, but by participating in them. Low costs, broad diversification, reinvested dividends, and time combine into a powerful engine for growth. John Bogle summed it up best: "In investing, you get what you don't pay for. Keeping fees low allows compounding to work fully in your favor." In the end, investing in the S&P 500 throughout the year doesn't guarantee riches, but it offers one of the highest probability paths to financial independence ever available to ordinary people. When education explains the mechanics, motivation sustains consistency, and time is allowed to work, the results can be life-changing. As Warren Buffett famously said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." For most investors, compound interest is the part they can control, and over time, it has the power to turn steady investing into lasting wealth.